At Cushman Wakefield, we take great pride in putting perspective on the changes that are taking place in the office markets. It is my pleasure today to introduce my colleague, Stuart Barron, National Director of Research for Canadian Office Markets, to share some of his insights on what is happening in Toronto's GTA office market. Stuart, welcome. These are exciting times we're in, and I'm just curious to get your perspective on what do you see happening in the office market today?
Thanks, Paul. I think what's remarkable about this story in the first quarter of 2011 is that we continue to see an unprecedented expansionary cycle in downtown Toronto. It really began last summer. That was the first quarter where we saw evidence that we were in fact maybe entering an expansionary cycle. And then in the fourth quarter of 2010, this story was about 50% or more of the transactions larger than 10,000 square feet in downtown Toronto were actually expansionary in nature. And in the first quarter of 2011, that has continued with over 70% of transactions greater than 10,000 square feet were actually had an expansionary component. Now, while the original kind of demand surge in downtown Toronto was driven by the banks, what we've seen is that has expanded into really a wide variety of sectors, including insurance, including the nonprofit organizations, including education, including finance. So we've really, again, downtown Toronto kind of defies expectations when it comes to demand resilience.
I know we were all concerned that we'd have a massive oversupply problem for 3 years ago when the new buildings were announced, and that doesn't appear to be a concern today. And if anything, we're seeing some upward pressure on rental rates. What's your view on that?
Yeah, it was remarkable that in a period where we expected the global recession to really hit the markets hard, we had 4.5 million square feet of new developments coming to market. There was an expectation that would push us into the teens in terms of the vacancy rates. Instead, downtown Toronto in the first quarter of 2011 is actually at a 5.3% vacancy rate, which is enormously tight. Not only that, but the AAA towers saw vacancy fall from about 8.6 down to 5.9. And there's an expectation based on the space that's coming back to market that the AAA rate will be rising, not falling. So really, I think, and that has accelerated rental rates. We've seen over the past 4 to 8 months, rental rates in some of the A-class buildings rise as much as $1 a square foot a month. Now, there was some pressure that was expected because some of these buildings had vacancy issues. And as those vacancy issues were taken care of, there's a natural settling of rental rates upwards. So we don't expect that velocity of rental rate pressure to continue. But I think what will create the balance in the marketplace looking forward is the fact that we still have, the new towers have been really well received. There's a lot of tenants who have locked in place. There's one tower that has still to come to market, as you're well aware. But as those tenants relocate into the new towers, we're going to see about 2.2 million square feet of space come back to market. And that's going to help us create the balance in the marketplace to prevent an overheating and to create a balance that doesn't shift us towards a landlord's market at too fast a pace.
So do you see some potential for new office development in 2014, 2016?
It's a great question. I think it's inevitable. When we look forward, we look at our projections towards 2 to 4 years out. The market is going to continue to get tighter. Outside of the AAA towers, vacancy may rise to 7 or 8% in the Class A in both the financial core and the fringe markets with the space that's coming back. But at the same time, demand is hot in downtown Toronto, and it's going to push rental rates to the point where it's very economically viable. Not only that, but a lot of the tenants in the marketplace who are not locked in new towers, there is a tremendous interest in those new towers from an efficiency perspective, from a sustainability perspective, and from a workplace strategy perspective. So it's likely we're going to see 2 or 3 announcements in the next 9 months, in the next 3 quarters, to push up somewhere between 1.3 and 2 million square feet of new developments between the years 2014 to 2016.
It's encouraging news. You know, back in the fall, I thought a very interesting piece on the tale of 2 cities, where you talked about downtown, but also there's a different story in the suburban markets. And what's happening there now?
Absolutely. In fact, it's not even, both the central and suburban stories are Canada stories as much as they are GTA stories, which is important to remember. The suburban markets had a much closer connectivity to the US business activities, so they were hit much harder. In fact, they were hit in a way that they've never been hit in the past. For the first 2 years following the recession, For instance, the Greater Toronto Area West market has basically zero demand, zero absorption in the marketplace. And yet, the good news story is that over the past 2 quarters, we've seen a demand revival in the West and in the East markets. So the vacancy in the suburban markets has peaked. We're heading towards far more optimistic days as far as suburban demand goes. Because there was kind of a negative supply shock in the suburban markets as well as a negative demand shock, because new development activity was curtailed to such an extent as it was, we actually have vacancy rates that are relatively low, even though demand has been zero in the suburban markets. So it kind of puts us in a place where an excellent launching point is what I'll call it. So the suburbs, even though demand will grow slowly over the next 3 quarters and then will accelerate into 2012, I think that they're at an excellent place, and we will see stable rental rates in the majority of the suburban markets more quickly than one might anticipate.
Let's come back downtown, and especially around the fringe area. It's often an area that we don't talk enough about, and I know that Allied Properties are looking to build a new building on Peter Street. There's Waterfront Toronto and Hines Development, and et cetera, et cetera. So what's your view on the fringe market?
It's another great question, because demand has shifted in the sense that it used to be you had to be at center ice. Now, downtown Toronto, the fringe markets, whether it be north, south, east, or west, they're attracting a great deal of attention. And if you take a look at, for instance, the largest fringe node, the downtown north node, which has about 15 million square feet, we have a vacancy rate right now of 3.3%, and that's like saying doors are closed for new activity. So it's been remarkable seeing the demand both in all the fringe markets. One of the reasons is because of the kind of velocity and demand in the fringe markets is because tenants are looking for cost-effective space, and the realty taxes and operating costs in the fringe markets is slightly lower, and that helps from manage costs over the long haul.
What's driving this demand from companies who want to stay downtown, but what's happening with the new worker? You referred earlier to workplace strategies changing, and seems as if the demand for, or maybe it's younger, I guess what I hear is that younger employees want to stay in a downtown market. Is that borne out with the research that you've done?
Yeah, it's very consistent with, for instance, the level of development of the condominiums that surround downtown Toronto. There's a tremendous desire for the young workforce of today to be in Toronto during the day and play in Toronto at night. And I think that that's part of what's driving the demand, and it's also rejuvenating kind of the optimism from a business perspective in downtown Toronto, so that business leaders who recognize that the workforce is in fact here and will continue to grow here, and who want to tap into that workforce, are thinking of new developments, are thinking of new workplace strategies, more collaborative work environments, and kind of retaining and winning the kind of employees that are going to differentiate them in the years to come.
Excellent. Stuart, thank you very much for joining us in this discussion today. Your insight is always valuable, and we appreciate it very much.
Thank you very much, Paul.